Hey there, focused learners. Welcome back to another deep dive on the Explainer. So today, we're actually cracking open the vault on one of the most exclusive, high-stakes corners of the entire financial world. You know, if you've ever watched a company prepare to go public, an initial public offering, or IPO, well, it can honestly feel a lot like an exclusive nightclub, right? There's this massive line around the block, the velvet ropes are up, there's just a ton of anticipation. But long before those doors actually open to the general public, there's already this select group of VIPs inside basically kicking back at the best tables. Today, we're going to decode exactly who these VIPs are. We call them anchor investors. By breaking down our source material, we're going to figure out exactly how they operate, what it actually takes to join their ranks, and ultimately, how much power they truly hold. Okay, let's dive into this. When we look at the raw data surrounding IPOs, the term anchor investor just appears constantly. It acts almost like this, gravitational pull for the rest of the market. But who exactly are they? Like, what gives them the right to hold this title? It's kind of the central mystery for anyone trying to really understand market dynamics. So to figure out who's actually behind the curtain, we really need to look at the specific classifications laid out in our source material.
Section 1. Decoding Anchor Investors, the alphabet soup.
So looking at these entities, we're faced with a literal alphabet soup of financial acronyms from our source data. On one hand, we've got FPI, which stands for Foreign Portfolio Investors, DII, or Domestic Institutional Investors, MF, which you probably know as mutual funds, and AIF, Alternative Investment Funds. Now, the result of combining these massive pools of institutional capital, that gives us our answer. These specific entities, and literally only these types of heavy-hitting financial institutions, are the ones who collectively form this VIP group known as anchor investors. They aren't your everyday retail traders, right? They are massive financial vehicles moving serious capital. Which naturally brings us to the next logical question about our VIP club. Section 2. The price of admission. Now, what's really interesting about this setup is that the price of admission isn't just some flat fee. It actually depends entirely on which door you're trying to walk through. Our source data distinctly separates the IPO market into two completely different paths. You have the SME route, that's small and medium enterprises, and then you have the main board route. And each of these paths has a completely different financial threshold you have to hit just to qualify as an anchor. Let's look at the SME route first. To even be considered for anchor status in a small and medium enterprise IPO, our data shows a minimum requirement of 1 crore. Just think about that scale for a second. This is just the baseline. The absolute minimum buy-in for the quote-unquote smaller tier of public offerings is still a highly significant sum. It effectively acts as this massive barrier to entry, making absolutely sure that only serious, well-capitalized players can participate at this stage. But if you want to play in the big leagues, check out this massive jump. For main board IPOs, the minimum requirement literally skyrockets to 10 crore. This stark contrast perfectly highlights the true exclusivity of this financial club. The main board is where the largest, most established companies go public. And to be a VIP there, you need 10 times the capital of the SME route. It's a staggering baseline, honestly, and it proves that anchor investors are, without a doubt, the undisputed whales of the IPO ecosystem. Section 3. Beating the clock. Tracing this timeline out, we can see exactly how these major players managed to skip the line entirely. So at the second point, we have day zero. This is when the standard IPO opens to the public, right? It's the exact moment when regular investors and even some other institutions can finally start bidding for shares. But back up to the first point, for anchor investors, their window doesn't open on day zero. Their window actually closes 1 full day prior. They've already committed their funds, they've secured their allocations, and they've completely finished their business before the starting gun even fires for everyone else. So the crucial point is, this window closes 1 day prior. This front-of-the-line advantage is basically the defining privilege of being an anchor investor. And why does this actually matter to you as someone tracking these markets? Because by locking in these massive multi-core investments a day before the public launch, anchor investors provide a massive vote of confidence. They literally anchor the IPO. They're signaling to the rest of the market on day zero that, hey, the water is safe to swim in. Section 4. Slicing the allocation pie. And this brilliantly illustrates the macro view of an IPO allocation. According to our source data, a massive chunk of the total IPO pie is strictly reserved for qualified institutional buyers or QIBs. The data actually notes this range is typically between 25 to 45%. That 45% maximum slice, it just shows how incredibly substantial this institutional block can be. The remaining 55% is left for literally all other categories of investors combined. But here is where the story gets really fascinating. Because that QIB slice, it is definitely not shared equally. Let's see how this builds when we zoom entirely in on just that institutional QIB slice. A jaw-dropping 60% of that initial institutional allocation goes directly to our anchor investors. Seriously, 60%. The remaining QIBs, the ones who didn't get in a day early, they have to fight over the leftover 40%. This VIP group doesn't just get to the buffet first, they are allowed to take the absolute lion's share of the premium offerings before anyone else even picks up a plate. So, we've decoded the alphabet soup. We've seen the 1 to 10 core minimums. We know they operate a full day ahead of the market, and we can clearly see they absolutely dominate the institutional allocations. Which brings us to this final thought. When you step back and look at this highly structured, immensely capitalized ecosystem, with up to 60% of institutional shares locked up by this VIP club a full day early, who really drives the IPO? Are the public markets truly public? Or is the success of an offering decided behind the velvet rope before day zero even begins? It's a really fascinating dynamic to keep in mind the next time you see a company ring that opening bell. Thanks so much for joining me on this explainer, and as always, keep learning.